Peter Rose, Longwood Currency Trading. Coffee first, no one gets hurt. How do you deal with unknown events that are going to happen to you during your trading? That's a topic that I want to talk about today. But before I do that, I'd take the bow dog out. There's the bow. There's the bow dog. He wants to go out. So let's take the bow dog out for a walk. I'll get my first sip of coffee and we'll get on with this video. The bow dog wants to go out. All right, let's go. And it's sunny, but man, it snowed. We're expecting a big storm Saturday. Got more wood to get in, and you know what I need to do right now? I need to go start the wood stove because it's getting chilly out right now. So let's go do that. See what happens after that. All right, Bo, come on in. Come on in. Let's go. Your fans are waiting. But what I need to do right now is to get a fire going in the wood stove. So let me get some wood. We'll go from there. All right, let's get this wood stove going. It's a little cold out today, and I just carted out some of the ashes. Got some new wood. We're ready to go. Alright, so we're set up in the kitchen here because it's so pretty out looking out the windows. It just snowed overnight, and so I thought I'd conduct my little chat in here. But what about these unknown events that you're going to encounter in your trading? How do you deal with that? Well, you know, that's got to be part of your, not your written trading plan, but it's got to be part of your process as a trader to start with. There's always going to be unknown things that are going to happen. Well, what do you do with them? Well, if you don't know what they are, how are you going to deal with them? But that's the issue. You can't not trade because you don't know what may happen. So how do you resolve all that? Well, that's what I call principle-based trading. You have to conduct your trading the same way you conduct your life, based on principles. Now, I'm a good person. I'm going to drive my car and I'm going to follow the rules of the road as I know them. And then some asshole pulls out in front of you, and that's an unknown event or an unexpected event. So how do you deal with that? Well, you use the knowledge and the experience and the information that you've accumulated, and you slam the brakes on and turn the car, swerve it to get out of the way. Are you going to train to do that? I mean, when I taught my kids how to drive, we went down to a big open parking lot. It was in the winter. That's obviously, you turn that age, you start driver's ed and stuff in the fall. And I mean, I had taught them to drive, and everybody handled all that stuff. But to learn how to drive in adverse conditions, after they were in their driver's ed courses, I took them down to a big parking lot where it had just snowed, and the snow was still like 4 inches deep and all over the place. And we took that car and we broadsided it, we backed it up and hit the brakes, and we ran the thing into a snowdrift to see what that would like when the wheels up on uneven snow, just to show them that the skills that they were learning were directly transferable into unknown events. And so if you do your trading education the right way, and it doesn't matter whether you're just starting out with a couple of months or a couple of years experience, we're all concerned about those unknown anomalies. How do you prevent that from happening? You know, most of the traders that I know will have a panic stop at some point. You know, as a short-term day trader, you know, I'm in there banging around. Sometimes if I'm scalping, I'm not going to have a a stop loss, a hard stop loss, because I'm in and out, in and out, in and out. So I'm not setting that short stop that I talk about. If I'm simply doing day trading and going to take 1 or 2 trades during the course of a 2 or 3 hour period of time, then I'll do my trade entry and then I'll set that short stop at 8 pips. I'm working on an ATR of 5, so the 8 pips is, that gives me some room, and yet if it gets hit, I know I'm wrong and I'm out. But if I'm in the middle of scalping, I've been involved in situations, and I'm sure you have too, where the prices spike 20 or 30 pips, boom, just like a bat out of hell. In a previous video and in a blog post, I'll see if I can remember to put the reference down. If I don't and you're interested, you can email me and I'll send it to you. But I gave an example of a 132 pip pin bar on a 1 minute chart. So the price went up 132 pips and came down 132 pips in 1 minute. If that wouldn't make your roids lock up, I mean, even if you didn't have any heat, if you're carrying a mini lot, you still lost $132 if you topped out and got out at the end, right? You couldn't take that heat. And if you're trading with a 5 lot, $50 times 132, yeah, come on, you just don't even want to think about that. So how do you deal with that kind of thing? Well, most traders set, again, what we'll call a panic stop. And if it's, for example, for me, on a day trade basis, I'm farting around and I'm grabbing 3 pips here and 5 pips here and losing a few pips and, all that other kind of stuff. But should that event happen, I've got a 20 pip hard stop out. Now, if price pin barred out and took me out, I'd lose the day and probably maybe the day before at 20 pips. If I'm trying to get 2, 3, 4, 5, 8, 10 pips a day, or I'm scalping for that, and then I drop 20 pips on a panic stop, particularly if you're trading with some heat at the wrong time, you're going to get jammed up. But it won't be as bad as if it goes 130 pips against me, right? And you go out and get a cup of coffee and you come back and you're down $8,000. Look, I know what I'm talking about. I've had that happen. And I just go, holy shit, I'm 8K down. I'm going to sit here. I'll just ride it because I think that's an anomaly, and I think it'll eventually right itself because of my experience and all the other stuff, and it comes back and I'll make a couple $100 on the day. But that initial push, phew, man, that'll take your breath away. So how do you deal with those events? Well, set yourself a little protection, a panic stop, somewhere where you don't anticipate the price to go in the time period that you're trading. If you're trading off the daily chart, don't set a 20 pip panic stop, because that's some bitch you're going to get hit. Okay? You're going to have to set that. If you're on the daily chart, most of the majors got anywhere from 80 to 120 pip ATR, right? Let's call it 100 pips. So where are you going to set your panic stop at? What's a panic? 2 ATR, that's not a panic. 200 pips, that's not a panic. You're going to give that, if you're trading up on the daily chart, you're looking for 3, 4, 500 pip move, 300 pip move. If you're trading with a lot of heat, why would you look for a 300 pip move? Why wouldn't you look for a 10 pip move and make a couple of $1,000 for the day in 10 minutes? I don't get the logic of it, but nonetheless, if you're a day trader and you've got a 100 pip ATR, well, you're not going to set your panic stop at 100 pips. Your normal entry stop is going to have to be 150, 200 to give that price room, as they say, to breathe, which is just ludicrous to me. But if you believe that shit, that's fine. Well, that's what you're going to have to do. But if your normal stop loss, entry stop loss, is a couple of 100 pips, then what's a panic? If your normal stop loss is 200 pips and you got a 100 pip ATR, your 2 ATR for your normal entry stop, you're going to be probably 400 pips would be your panic. I mean, you're looking for 400 pips on the gain of the day, which means you're a day trader, and so that's normally what you're shooting for. So the idea here is that you're getting 250 to 350 pips when you win in those scenarios. And so if you take a 400 pip panic stop loss, you'll be okay. Yeah, 400 pips is a lot of hit to take because you're trading a 10 lot at 400 pips on a gain. Yeah, you know, it's the same thing, same amount of money. It just it's $100 times 400 pips. That's a lot of money. So that's how you would mechanically deal with it for some anomaly. But the true question to ask yourself is, and this comes with experience, is what is the probability that an anomaly like that will happen? The fact that you can conjure up, oh geez, this thing could pin bar 132 pips on me, has to be based on not you just sitting there with your thumb up your ass projecting that. You'd have to seen it, somebody would have to told you about it, you'd have to go back and in your research of your price action in a particular currency pair that you're trading, and 132 pip pin bar at that type of currency pair is an anomaly. How many times is that going to happen? If it happens 1 or 2 times a week, I'm not really sure that that's the kind of currency pair that you want to trade. The fact that you can conceive of an event means that that event is very possible to occur. So that therefore there is a probability for its occurrence. Now that might be out 6 standard deviations as a 0.02% likelihood. It might be out 3 standard deviations. Let's call it 3. And a 3 standard deviation event is not a black swan. A 4 is not a black swan. But you're 3 or 4 standard deviations out that particular type of event would occur. But it's there. Even if you fat tail your curve, it's there probably statistically more times than you might think. You might find that happen twice a year. If you trade a lot, you're going to hit that. So how do you plan for that? Are you going to be in fear of it? That's why risk management is so important. If you have good risk management behavior or rules, it'll keep you out of the shit. You know, the Chinese have a saying is if you don't want to get bit by the tiger, don't walk in the woods. Well, you know, well, carry a big gun, have a lot of people with you banging on drums, scare the tiger away. Don't walk so far deep in the woods. You can still walk in the woods, just do it reasonably. If you do these set and forget things and you're not paying attention to where your stop is, and you're not paying attention to the fact that you could blow through that stop point due to illiquidity. If you're trading the Turkish against the Taiwanese yuan or something, you could, I mean, you're just asking for trouble. But if you're trading on the majors, which is where you should be, if you've got less than a couple of 3 years experience, 4 years experience, you should be trading deep crosses or exotics. But if the likelihood of something similar to 132 pip pin bar is possible, you can't just set your price and go, well, you know, I'm shooting for a 400 pip gain. I'll set my entry panic stop to 400 pips, and I'm looking for 200 on just a regular stop loss. I go into profit. and I then move my trail and stop up a little bit. Maybe I come up to trail it 100 or 200 pips behind where the current price is. Where's that panic stop going to go? We're going to have to bring that up. Maybe you want to just say, I'm gonna have that panic stop at the break-even point, because if I miss the one up there, I want to be able to catch this. Where would you lose liquidity? You know, if your price is jacking way up, there's going to be thin liquidity on the way, because if that price breaks and drops, it could drop 100 or 200 pips just like that, because there may not be the liquidity until you get down here where all these people that caused this thing to start going up, they all got in here, and that caused the retail traders to jump in as well with it. The institution is going to be playing it up there. They're just going to ride it. And so that's an indication for you, taking those things into consideration as to where that panic stop should be. Always be thinking about your risk. And once you have 2 or 3 basic risk mitigation rules, you're done with risk. You're done. Now you worry about how much you can squeeze the price for it to get out of it, because you're not worried about what your risk is. You're not worried about the anomalies that are going to happen. And you can have fun with your trading, knowing that in a worst case scenario, you're pretty well protected. Now, if you're going to go through something like the Swiss currency collapse, and I mean, there were brokerage houses that went out of business because the price would, it just went all over the place. And traders got wiped out all over the place. What's the likelihood of that happening? The likelihood is there. So when you get just a complete flush out, well, nobody's any better off than you are. When the ocean liner sinks, that's it. It's done. It's gone. Everybody's there. It isn't just your little lifeboat that went out and sank, that you can kind of plan for. But again, if you go into highly volatile market periods where there's a tremendous amount of uncertainty, we're about to have a non-farm payroll release, and the other country's central bank is about to fiddle with the interest rates, and you got all this stuff going on, why don't you just not trade? That's risk management of the highest order. Go have a cup of coffee. Only trade when it's safe. How do you know when it's safe? You learn that through experience. You learn that through looking at your risk management plan, and then conduct your life accordingly. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.